Okay. Okay, basically you've got two different ways to account for non-current assets. You've got the cost method and you have the fair value method. So the choice, you're basically given a choice by the accounting standards. You either use the cost method or the fair value method. Okay, fair value, another word for that is market value. Okay. So cost is when we buy the asset, you know, whatever it's cost us, we'll put it in the books at that cost. The ruling there is that the asset must always be at the lower of cost and recoverable amount. Okay, so I said to you that what is recoverable amount? It's the higher of net selling price and value in use. Okay. So basically if you're using a cost method, then you must record the item at, you must always make sure that it's recorded at the lower of cost and recoverable amount. Okay. And we did some examples last time I saw you, I think. Okay. If you're using the fair value method, basically what happens with that method is that you can be updating the actual value of the item to fair value. So, for example, if you've got a building and it's in the books at 1 million. Okay? End of the year, you find that the building has a fair value or market value of, say, 1.2 million. What you can do is you can actually increase the value in line with the market value. So you will debit the asset, okay, and you will credit. There's a bit of a long way of doing it, which I'll go through with you as well. But basically, you'll credit revaluation surplus. Okay. Okay, revaluation surplus is going to increase your equity. It's kind of like a gain, but it doesn't go through your income statement. I mean, it doesn't. It's classified as other comprehensive income. What do we mean by other comprehensive income? In your income statement, we've always had profit minus expenses. Oh, sorry, not profit, revenue. Gives you profit. Okay? All familiar with that? What they do now is they then add other comprehensive income to get the total comprehensive income. Okay. And what we now call this, instead of calling it an income statement, we call it a comprehensive income statement. We call it a comprehensive income statement. So basically we've got an add-on, and it's this bit here. So if we, for example, had increased the asset by 200,000, ignoring tax, revaluation surplus is 200,000, we would have 200,000 coming in here under other comprehensive income. Okay, so it's not going to be a gain which comes over here. It goes straight to the equity section of the balance sheet, and this forms part of the equity. But obviously, it's going to be beneficial to the company. It's actually increasing the value of the company, isn't it? Okay, questions on that? No? Okay, so basically, what we've done here is we've said, okay, we bought the building for this price. It's recorded at 1 million, but In the following year, we find that the item has gone up in value and it's now 1.2 million. So the fair value or market value is 1.2 million. So we put through this journal entry. Okay? Okay, if we find the following year it's actually gone down to 800,000, what are we going to do then?
Debit revaluation.
Okay, good. Debit revaluation surplus with how much?
200. Why surplus?
Why surplus?
Why would we call it surplus?
Revaluation reserve or revaluation surplus. So we've revalued the item and there's a surplus of 200,000.
Okay. 200?
Okay, you're quite right. Well done. Okay, what else will we do?
Credit the asset.
Okay, you're going to credit the asset with?
200 also?
Okay, wouldn't you say 400?
Yeah.
Okay.
Yes.
So what's the other debit going to be? It's actually going to be debit loss on revaluation. And why? Why didn't we just go loss on revaluation 400,000?
Because its original value is.
The only reason is actually because what we've got is we've got an asset with 1 million. Okay. We then take it up to 1.2. And that's the surplus, right? Okay, when we take it down to 800, just down here, it's not a proportionless diagram. Oh, sorry, let me bring it up a bit more. So take it down to 800, say here. What we do is we always reverse the surplus. And the surplus is only 200,000. So we reverse that. And then anything over and above that will go to loss on revaluation. Make sense? Okay, so we're going to have loss on revaluation here, 200,000. Okay, I'm going to give you an example and I want you to have a go yourself. Okay, so I'm just going to put up an example. Okay, so basically what I'm going to say is that I've got an asset purchased for, say, 500,000. Okay, end of year 1, fair value is, say, 550. Okay, end of year 2, fair value is 300. Or let me say 400. Okay, I want you to do any necessary journal entries. The necessary journal entries for that. The assets was purchased for 500. End of year 1, its fair value is 550. End of year 2, its fair value is 400.
Sorry, 4:30 and anyway.
Okay, 4:30. Do you guys just want to? Do you want to have a break? You probably do actually. Who does want to have a break? Or do you want to finish early? Honestly. Finish early? Okay. How are you going there? Finish? Who needs more time on that one? Okay, so what is it going to be? Here, debit asset and revaluation surplus. First journal entry is going to be? What's it going to be? 50, good, well done. And the second one, you're working with the same journal entry.
50, 100.
Say 50, and that's going to be here.
Yes.
Okay.
100.
100. And yeah. Okay, questions? Okay, I'll actually play a couple of YouTube videos before the end of this, I think, at least one. Okay, any questions on that? No? So what we've done is we've taken it up to 550, and then it's come down in value in the second year, it's come down to 400. So we've taken it down. We've first of all reversed the revaluation surplus, and then the rest of it we've taken to a loss. Okay? So the asset's gone up by 50 and then down by 150, and it's ended up being 400. Okay. Questions? No? Okay. What I just wanted to show you was, in the slides, what you're going to see is, okay, basically, this here was based on, if you go to chapter 21, it's one of the questions in chapter 21. Which was, yeah, it's basically on page 869, if you look at that page. You'll see that balance sheet, which is 150, motor vehicle 65, and accumulated depreciation 25. Okay, if you look at that, okay, so we've got land, and we've also got motor vehicles, and we've got accumulated depreciation. Okay. What I want you to do is look at land, just the entry for land. Okay? So don't worry about the motor vehicle one at all for now. Basically what we've got is the first journal entry we've got is land, and they've credited gain on revaluation. And they've put OCI in brackets, and what does that stand for? Other comprehensive income. Okay, the next journal entry, if you go to the next page, they have, okay, so if I draw up T accounts, this is what I'm going to do. Draw up T accounts. So they've done the following T accounts. They've got land, I think it was 150, and they've added 20. Okay. Gain on revaluation. OCR, and they've got 20 here. They've then debited this account, so that's been ignored. And they have credited what? Other comprehensive income summary. Right, so we got rid of that. They've basically done what I've done, but in a lot more journal entries. Okay, well, they've actually, they've taken the two together, but actually the land was 25, sorry, 25. Yeah.
In the book.
There's a mistake there. It should actually be 20. Yeah, there's a mistake. So it should actually, don't you know? It should be 20, shouldn't it? Under OCI, because they've got 25 plus 5 is 25, haven't they? Okay. And then the last one, they've actually taken 20,000 off. Well, they've included both for the vehicle and the land there. And they've then taken it to revaluation. And they've called it a revaluation surplus. So all I'm saying to you is that in that slide, okay, they've basically got like 3 or 4 extra steps there, which end up with the same as what I did on the board. You know what I'm saying? So in other words, what we've ended up with is debit land and credit revaluation surplus. Okay. I wouldn't in a test expect you to do those other 2 steps there. Okay? I've shown you why they've talked about the other comprehensive income summary, and that's because the revaluation surplus goes to the other comprehensive income account. Okay? So I just wanted to speak about that. Okay. What was I going to do now? Okay, so just the other thing that I wanted to quickly do was if you've got an item which has accumulated depreciation, we looked at land, which doesn't have accumulated depreciation. Okay, what if you've got something else? And I'm going to keep this very straightforward. Again.